Today, we're going to break down a really powerful investment framework from two of the sharpest minds in macro, Dan Morehead and Raoul. Their argument is pretty simple but profound. Crypto's rise isn't just another speculative frenzy. Nope. They see it as an inevitable, logical response to a global financial system that is, well, quietly falling apart at the seams. So let's start with this quote from Dan Morehead, because it really sets the stage. When he says this, he's not talking about some far-off, hypothetical future. He is describing what is happening right now. It's this silent, slow-motion theft of your wealth, and it's the absolute core of the problem we need to understand.
So, before we can even get to the crypto opportunity, we first have to wrap our heads around this massive problem in traditional finance. They call it the Great Debasement. It's basically this invisible headwind that's making it harder and harder for any of us to get ahead financially.
We hear this number all the time on the news, right? 3% inflation. It sounds kind of manageable, maybe even a little boring. But here's the thing. That is only one part of the story. It's just the tip of the iceberg. And here is the other, much bigger number that you almost never hear about. 8%. This is the rate that governments are actually expanding the money supply. In other words, printing money out of thin air. And you gotta understand, every single new dollar they print makes the dollars sitting in your bank account worth just a little bit less. So, and this is so crucial, when you add those two numbers together, you get this massive 11% hurdle rate. What does that mean? It means your investments have to return at least 11% every single year, just for you to break even, just to maintain your purchasing power. If you make anything less than that, you are actually losing ground, even if it looks like the numbers in your account are going up. And you can see how these big policy decisions directly affect everyday people. Look at the Swiss National Bank. When they printed money, what did they do? They bought productive assets, like US tech stocks. Now compare that to the Fed. They printed money and bought mortgage bonds, which had the direct effect of pumping up housing prices for an entire generation. These aren't just abstract economic theories, they have huge real-world consequences for all of us. Okay, so once you understand this debasement, it leads you to what might be the single most important idea in this entire breakdown. And I'm telling you, once you start to see the world through this lens, you just can't unsee it. All right, pay really close attention here, because this flips the script on everything. We think we're seeing all these different bull markets. Stocks are up, real estate is up, crypto is up. But that's not what's really happening. The real story is that the value of our currencies, the dollar, the euro, the yen, is collapsing. So everything that has a fixed or limited supply is just frantically trying to reprice itself against money that's being devalued every single day. I mean, do you really think it's a coincidence that gold, the stock market, and Bitcoin are all pushing all-time highs at the exact same time? No way. It's all one trade. It's a global escape from currencies that can be printed forever into assets that can't be. Simple as that. Okay, so if the core problem is the endless printing of money, then what's the solution? Well, this is where blockchain technology finally enters the picture. And you have to see it not just as another asset to buy, but as a fundamental upgrade to our entire financial system. One that was basically designed to solve this very problem. It's actually kind of wild. Back in the 90s, the brilliant economist Milton Friedman basically called this. He said the one thing the internet was missing was a way to transfer value directly from person to person without a bank or a credit card company in the middle. Well, that's exactly what blockchain is. It's the internet's long-lost money layer, finally here. And look, this isn't just theory. Think about the real world. That 3% fee on every single credit card swipe, the insane costs for a migrant worker to send money back home to their family, the 0.0% interest you get from your bank. Blockchain technology is aimed squarely at disrupting these massive trillion-dollar industries and making finance cheaper, faster, and available to literally billions more people. So with all this potential, it's pretty easy to ask yourself, okay, but have I missed the boat? Am I too late? Well, this next part is going to explain why we are still in the very, very early innings of this whole technological shift. Just look at that number, 0%. That's the median allocation to crypto from the world's biggest pools of capital. We're talking pension funds, endowments, sovereign wealth funds. The so-called smart money isn't even in the game yet. Like Dan Morehead says, how can you have a bubble that nobody owns? It's a great question. Every new asset class follows this exact same predictable path. First, retail investors like you and me get in. Then, the wealthy families and their offices start to follow. And only at the very end do the giant institutions finally show up. With crypto, we are right at the very beginning of step 3. The biggest tidal wave of capital is literally just starting to do its homework. And they're also getting brand new ways to invest. We've all heard about ETFs, right? They're passive, they just hold an asset. But then you have something like a digital asset treasury, or a DAT. Think of a company like MicroStrategy. They don't just hold Bitcoin. They're an active company that can generate yield and even increase the number of Bitcoins per share over time, which is something a boring old passive ETF just can't do. In the world of investing, "this time is different" are usually the 4 most dangerous words you can ever say. It's almost always a warning sign. But today, there are some really powerful, brand new forces at play that suggest the old, familiar crypto cycles might actually be changing for good. For years and years, crypto has followed this super predictable boom and bust cycle, almost like clockwork. It's all tied to these halving events. So the huge question on everyone's mind right now is that pattern finally breaking? Let's take a look. Just think about what's different this time. You've got a massive regulatory 180 happening in the US, which unlocks huge amounts of capital. You have actual sovereign nations, including the US government itself, becoming buyers. You have entire regions of the world now jumping into the space. These aren't just small tailwinds. These are multi-trillion-dollar forces that simply did not exist in any of the previous cycles.
And this really brings us to the final critical point. The whole conversation is changing. It's not about the fear of missing out, FOMO, on some hot trade anymore. It's becoming a much deeper, more professional fear. It's the fear of being massively underallocated to a fundamental technological shift that's changing the very fabric of money and finance. The question is no longer if you should have some exposure. It's becoming, how much can you really afford not to have?